What's up, family? Today I'm going to show you guys how to trade options on Robinhood. I know trading options can be a bit confusing, so by the end of this video, you will have a better understanding on how to trade options. So let's get right into it. All right. So options are contracts between a buyer and a seller that gives the buyer of the contract the right, but they're not obligated to buy or sell a stock or ETF at a predetermined price. And that predetermined price is called the strike price by a certain date. And that certain date is called the expiration date. Each contract is going to give you the right to buy or sell 100 shares of a stock. So, for example, two contracts will give you the right to buy or sell 200 shares. Now, when you're the buyer of the contract, you're going to pay a premium to secure that right. And when you're the seller of the contract, you're going to collect a premium to give the buyer that right. Now, there's two types of options you can buy or sell: a call option and a put option. A call option will give you the right to buy on 100 shares, and a put option will give you the right to sell 100 shares. So when you buy a call, you believe the stock is going to go up. And when you buy a put, you believe that the stock is going to go down. So just to keep this video simple, I'm going to focus more on buying a call and buying a put. In the description, you'll see a link of two videos that I did about selling a call, which is also known as the selling a covered call, and selling a put, which is also known as selling a cash covered put. I'm going to use Nikola for example. So to trade options, you're going to want to click trade options. Now, let's say if you believe Nikola is going to go up, then you're going to want to buy a call. So you're going to want to make sure you're on buy, and you're going to want to make sure you're on call. Here on the left are the strike prices. And if you decided to exercise your option, then you'd have the right to buy the stock at these strike prices. So for example, if I bought the $50 call and Nikola went up to $70, I would have the right to buy 100 shares of Nikola at $50. And you can either keep the shares or you can sell it at the market price. So here on the right are the premiums. So if I bought the $50 call, I would have to pay $3.85 worth of premium. And you would have to multiply that premium amount by 100 because each contract is worth 100 shares. So you have to multiply it by 100. So the premium is actually going to be $385. Now, as the stock price goes up, the premium will go up. So as you can see, the further down we go, the more expensive the premiums will get because they're in the money. And in order for a call option to be in the money, the strike price has to be lower than the current market price. So because Nikola's at $52, everything under $52 would be considered in the money. And everything above $52 would be considered out the money. Now, when the option is in the money, the contract has value. And if you were to exercise that contract, you would make a profit. When the strike price is above the market price, then it's out the money because the stock price hasn't reached that price yet. So if you were to exercise the option, you would lose money. It wouldn't make sense to exercise a $58 strike price when Nikola's at trading at $52 because that means you're gonna already be at a loss. When you choose a strike price, just remember the further out the money you go, the more riskier it will be because there's a smaller chance of it expiring in the money. And the more in the money we go, the more conservative and less risky it is because there is a higher chance of the contract expiring in the money. Now, because you don't have to exercise your option, you can actually flip the contract and make profit by the premium increasing. So if the stock goes up, so let's say the $50 call and you paid $385 premium. Let's say the premium increased to $600. You can sell that contract to another buyer before the contract expires and give them the right to buy those shares at $50, while you made profit of $215, and you never had to own the shares to profit. This is one of the reasons why traders and investors use options, because you can bet on a stock's move without buying the shares outright and using less money, because the most money you can lose is what you paid for. Now here are the expiration date. The closer you are to expiration date, the more time is against you because the contract has a chance to expire worthless. That's why premiums will be more expensive the further out you go. So when you buy an option contract, pay attention to the expiration date to see if it's possible to profit, because an option contract can lose so much value if the stock doesn't move in your favor and is out the money. Now, if you think the stock is going to move fast, then you would pick a close expiration. But just know it's harder for the stock to recover if it moves the wrong way, because there's only a few days till expiration. Now, to buy the call option, we would click on the strike price that we want to choose, which I'll pick the $50 call, and then we'd click continue, and you'd want to click one contract. When it comes to limit price, you want to put the amount that you're willing to buy the contract for. Now, $3.70 is what buyers are trying to buy the contract at. So that's the bid price. And $4 is what sellers are trying to sell the contract at, and that's the ask price. So you can either put an amount that you want to buy it at, or you can go closer to the ask price and get filled a lot faster. So I'll just keep it at 385. And then you click view order. And then because I don't have the funds in my account, I'd have to deposit it. Then I would just submit the order. Right. Now, if you wanted to buy a put, you're betting on the stock to go down. Now, if the strike price is above the current market price, then it's in the money. So everything that's above $52 is considered in the money. Now, everything that's lower than $52 is considered out the money. So to make a profit buying puts, Nikola would have to go down for the premium to increase and for the option to expire in the money. So to buy a put, you'd want to choose the strike price. Let's say I choose the $53 strike, and you'd want to click continue. You want to make sure you have one contract. And the limit price, you want to pick a price you want to get filled at. I'm just going to go closer to the ask. If I wanted to get filled right away, I would just pay the $600 and I would get filled right when the order goes out. And then you'd click review order, and it's the same procedure. I'd have to make sure I have the money available, and then I'd be able to submit the order. Now, if you wanted to close out an option because you either made money or you didn't want to risk losing the profit, uh, I'm currently in an option right now with Ford, and you'd want to click on the option, and you'd want to make sure you click sell. Then you're gonna want to put one contract, right? I'm selling one contract, and you're gonna get filled a lot faster if you go towards the bid price, because now since you're selling, you're gonna have to sell it at what people are wanting to buy, and when you're buying, you got to go what people are wanting to sell at. So you'd get filled a lot quicker if you go towards the bid price. So then we would go, we put 26, review order, and then I'll submit the order. So that's the basics on how to trade options on Robinhood. If you guys have any questions, please comment below. And if you guys are new to the channel, please subscribe. And if you guys found this video helpful, please give it a thumbs up. And I'll catch you guys on the next video.